Accruals are the other side of deferrals. Accrued expenses are costs incurred in a period that are both unpaid and unrecorded. So let's look at some examples of them. The expense increases, the liability increases. Let's look at a couple and they'll make more sense. They talk about adjusting the accrued expense account, determine what the current account balance equals, determine what it should equal, and then record the adjusting entry. So these are things like payables, things like interest payable that's building up as time goes by, and you're not going to pay it until it's actually due, but it's still accruing as we're going along. Salaries payable is a classic example that they give you where somebody gets paid on January 4th, but they've earned their salary up till December 31st. So let's look at the first one, is salaries payable. Year-end salaries expense of $5,000 has been incurred by the company but has not yet been paid to the employee, so it won't be paid till whenever, but it's accrued as of December 31st. Salaries payable should show a $5,000 balance, but it doesn't. So we're going to record the expense because it's an expense of this period, and then we're going to record the payable with a credit for that one. The next one is a mortgage payable. That's a loan. That's interest has to be paid on that loan, and they tell you it's $1,000 in annual interest that will be paid probably next year. Tells you January 3rd of the next year. It should still be recorded because it's been accrued in the current year. So again, debit the expense and credit the payable for that one. Accrued revenues are things that have been earned but haven't been recorded and haven't been received yet. Basically, somebody forgot to send out a bill or hadn't gotten around to sending out a bill for those yet. Accrued revenue account, we've got accounts receivable, we've got interest receivable. Those would be the accounts that you would use. So in this example, company has completed services of $1,000 but has not yet billed the client. You want to record the revenue because it's actually been earned, and according to revenue recognition that you're going to record it. Hasn't gotten here yet, so it would be accounts receivable and services revenue to adjust for that, to make all of your accounts be accurate. Interest receivable is the same thing. The company has earned interest on something, a government bond that they have. Again, they want to record that revenue and record the interest receivable that will be collected later on. This slide shows you what actually would happen if you didn't adjust the accounts. It shows you that your expenses would be understated if you didn't adjust your prepaid expenses, and it's a handy little slide to keep in front of you when you take a test because it shows you what the adjusting entry will be for each one.